Let's do a gold market update and talk about how we can be successful trading this gold bull market. As we can see on my stage analysis screening tool, silver stocks, gold stocks, Canadian silver miners, and Canadian gold miners are all close to the top of the markets page, which indicate that they are among the leading sectors in the market right now. And that's where we want to be when trading the stage analysis system. We can also see that many defensive sectors are still at the top of the list, which tells you that the overall markets, although they've rallied over the last 3 to 4 weeks, still aren't in position to move back into a new bull market. Now, looking at the chart of GLD, we can see that last week we had that symmetric triangle formation on gold, and we actually broke out of that pattern towards the end of last week on pretty good volume. We can see that average weekly volume is about 37 million shares, and we did almost 70 million shares last week, so that's almost 2 times average volume. I saw a lot of gold analysts predicting that gold would actually break downwards out of the symmetric triangle formation, which is kind of peculiar because this pattern is typically a continuation pattern. So, and since we just launched into a new uptrend, the continuation pattern most likely would have been a breakout to the upside, even though gold was overbought here. And we'll talk about how things can remain overbought for a long time in bull markets. But another couple good points to look at this chart. Critical resistance at the 110 level has been broken now on GLD, and that held as support back in late 2014 and in 15, and then was resistance back in late 2015. So we're above that now. Also, we're above the resistance at the 115 level, which was support back in late and mid 2013. So those are two very important technical levels that we're above now in gold, and we really don't have much resistance to get back above anymore for gold to be pretty much without resistance in its new uptrend, because typically you only look at resistance going back the last 2 years. So all we have to worry about really is some of the price action in early to mid 2014. So once we get above like the 125 level or so on the GLD, we're really in a new uptrend with no overhead resistance. And notice that we're outperforming the S&P 500 now as well, which has been going on since the beginning of the year. Very important things happened in silver last week. Silver was acting pretty weak relative to how well gold and gold stocks were performing, but we can see that SLV, after it broke above the 30-week moving average a few weeks ago, it retested it 2 weeks ago, and then had a very strong week last week with 60 million shares traded, which is 2 times average volume, and we're now back above the 30-week moving average and getting close to being above the 50-week moving average. So silver is going to be very important to watch going into the next few weeks, because we're at a critical point where we could really start to see this uptrend start to kick into higher gear, especially because the momentum chasers are going to go into some of the things that haven't rallied as strongly in the precious metals area, which is definitely silver and some other mining stocks. So, and silver's got some resistance right at 15 on the SLV. So if we can just get above this within the next few weeks, it's going to be very bullish for silver. Platinum actually is starting to perform along with gold and silver now as well. After having a high volume week back in early February, last week had another bullish advance similar to silver, where we retested that 30-week moving average and then we're still holding above it. So you're seeing the whole precious metals complex start to trade along with gold, which is what we want to see for a real gold bull market. Now, let's talk about how to successfully trade a new bull market versus making some of the key mistakes that many people make, that cause them to not perform as well when trading bull markets. So, taking a look at the Tesla for an example, one thing to note is that once we break out into a new stage 2 bull market, a lot of times the strongest advance is out of that stage 2 breakout, which is why the stage 2 breakout is called the ideal buy point, because usually the first advance is the biggest advance. And for an example, Tesla here essentially went up four to 4.5 times from the 40 level all the way to over 180, before it had its first major correction. And notice that Tesla stayed overbought for like 5 or 6 months during this entire advance, which is one of the key mistakes that traders make, is when things get overbought, like on an RSI, for example. This is showing the RSI 14 on a weekly basis. It remained above 70 for all these months and actually got even above 90 for at least 2.5 months. And notice that Tesla, all it did was go up and up and up this whole time. So anybody that was trying to get cute and time Tesla and get out of it here, if they didn't get back in immediately over the next few weeks, they lost out on future gains. And if you get in close to the ideal buy point around 40, every time you sell and then buy again, your percentage gains potential is diminished, because from 40 to, let's say, 120, for example, that's a three bagger. But if you sell out, miss a portion of the gain, then buy back in, now you're sitting at an entry point at 120, and you have to wait until another major advance to be sitting on big gains again. So the point is to never lose your position in a new bull market. You can sell partial positions. I'm an advocate of selling portions of your position if you want to do a little bit of trading around these big moves, but never sell entirely out of your position, because you never know how strong a bull market advance is going to be. And you just, that's where you're going to fail, is people, in bull markets, the surprise moves are to the upside, not to the downside. Now, another way to be unsuccessful is to buy late in these rallies when there's euphoria from the media and other outlets, and then sell when because you get these big corrections. Typically, you're going to have a correction back to the 30-week moving average every few months or so. In strong bull markets, they'll only come a couple times a year, but in more volatile asset classes, you'll see more pullbacks. So a way to fail is to buy late and then sell on these dips, instead of doing the opposite, which is, these are where you want to accumulate more um, in the bull market, because this is the next best buy point essentially. And the only time you want to sell is when it transitions back into a stage 4 bear market. Now, another thing to note is that when you buy late in a bull market, you have diminished chances of actually making big gains. Notice that on the second pullback in Tesla, after the bull market had been going on for about a year, Tesla pulled back to 180 again, and we got another advance to 280, but the subsequent pullback took us back all the way to almost the second buy point entry level. And this is where Tesla started to break down and trade sideways for pretty much the rest of its life cycle so far. So the earlier you get in the ideal buy point is where you want to be, buying and holding from, and not worrying about, um, the media is going to get hyped up when things have gone up a ton over a multi-month to year time frame. So this is where the media was, obsessed with Tesla, but anyone that was getting in on their hype was losing money potentially because the trading opportunity is just not there anymore. Astute traders using a technical system like stage analysis would have timed their entries back here, and would be enjoying the big gains that they missed out on. Now, quickly looking at like a silver stock like First Majestic Silver, we can see again here that after this broke out into a stage 2 advance, it really never pulled back to that 30-week moving average, all the way until its ultimate top here, which was retested multiple times after it topped out in April 2011. So again, um, once you at that ideal buy point, you really don't want to lose your position because all these monster gains in First Majestic, which occurred over a period of about 7 months or so, you just never really had the opportunity to get back in that much if you sold out too early and missed out on things. And notice that First Majestic stayed overbought for pretty much the entire bull move again. And if you bought late into First Majestic, you had lesser chances of being successful. Now looking at GDX, we can see that we're still sitting on that early stage 2 buy point here. So, and we're not even overbought yet on a 14-week RSI. So again, if we're in a new stage 2 bull market here, the best thing you can do is maybe trade partial positions if you want to do a little bit of hedging, but never lose your entire position because the longer this thing goes, the bigger your gains are going to stack up, and the worse off you're going to be if you lose your position and try and trade in and out of it and miss these big moves that typically surprise to the upside.